Good morning, everyone, and thank you for joining us for this workshop today. This workshop is going to go into some things that we should be considering when we're starting a business, when we're in business. Like, it's stuff that we should be focused on aside from just selling our product and service, right? As business owners, we know what we know. We know that we have a product, we know we have a service that we want to offer, we know that we are excited about it and that there's people that want to buy it, but do we know the administrative side of the business, right? Do we understand that there's money that flows in and out of the business, and we have to be intentional about how we manage that money? We have to know where the revenue is coming from. We have to know where our expenses go. There's a lot we got to know. So this presentation is going to give us the opportunity to kind of dig into some of that. And I always like to start off my workshops with foundational information, right? So what really is a business entity? Do we even know what that is? So let's start talking about that in the beginning. So this is going to build into what we want to talk about as far as the workshop is concerned. So follow me here. And I'm going to ask you some questions. So these questions, take some time to think about it. If there's somebody standing next to you, ask them. And then, I want this to be a little interactive, all right? So, we're going to start with a show of hands. Who already has a business up and running? Good, very good. All right, and who's still dreaming or in the planning stage? Like, who woke up and said, oh, there's something I want to do, or I want to start a business, but you haven't taken that step yet? Good job. All right, there's a couple. Very nice, very nice. All right, so by the end of this hour, you'll know which business entity will fit you, all right, and how to keep your expenses under control from day one. So this is the topics that we're going to talk about. First thing is the foundational side. We're going to choose our entity, right, and then why it shapes your money, right, the bridge from entity to expenses, because really there's a correlation there. So, depending on what kind of business entity you are, your expenses are going to change, and how you manage those expenses should change as well. So it's information that you're going to need to know. And then we want to manage our expenses like a professional, right? Simple steps that are repeatable, that you can write down and take advantage of. And then we're going to have a little quiz, because I got to make sure you guys are following along and aren't sleeping. Right? And then we're going to have some takeaways, some stuff to leave with. So that's going to be the agenda for this talk. And let's go on. Let's get it started. So, choosing your business entity, right? This decision has to come before everything else. Listen, so many people, they start off wrong, right? Number one, you go all the way into like the most complex C corporation business entity, because that's what you see online. That's what the gurus are telling you to do. So you think that that's the direction you have to go, and it's the wrong decision because it's so much involved in managing it, right? So understanding your business, what you offer, and the type of risk that's involved with what you do goes into the type of entity you should create. So let's go into some of those entities. Actually, we're gonna go into, the decision-making process around entity creation, right? And this is a good analogy. When I was doing my preparation, I came across these analogies, and I was like, this is great, because it actually, helps you envision the type of entity and what's involved and the risk associated with it, right? So let's look at a sole proprietor. A sole proprietor is you. That means the business is under your name. That means you carry the risk. It's like riding a bike. You see here? It's easy, it's cheap, right? You control all the effort. You're the one pedaling the pedal, right? But also, you control all the risk. If you fall off that bike, you're gonna get scraped up. It's gonna hurt. God forbid, that's all that happens to you. Or no, Lord willing, that's all that happens to you if you fall off the bike, right? But a sole proprietor is like riding a bike, where you are the engine, you are the driver, but you are also assuming all the risk of your business. So if something happens, there's no buffer. It's you. The car provides a little bit more protection, right? You're surrounded by metal, right? And you can also fit other people in the car. So an LLC which is the car, right? The sole proprietor is the bike, but the LLC is the car, right? And that allows you to fit other people into your business with you. You can switch conductors, that you can go on a road trip, and it's got a little bit more protection. You got an airbag in the car. There's ways to protect your business as an LLC, right? Now, a corporation is more like an RV. An RV, you can stuff it with people, right? You can fill it up, you can go long distances, but there's more maintenance, and there's more, you have to, really take care of that machine. The gas that goes into that machine, it takes a lot more gas, it takes a lot more maintenance, it takes a lot more just focus on the corporation. So that let's just say, it's got more rules and it's built for like long hauls. An RV, you can go from coast to coast, right? If you need to sleep along the way, you switch and but it's meant to go the long haul. LLCs are cars, you can go shorter distances, although you can go cross country in the car. It's uncomfortable, but you can do it, right? I don't recommend driving cross country in a bike, right? Some people have done it, but those are the outliers, right? Not everybody's an outlier, so I just don't recommend riding cross country in a bike. Now, we're getting a little bit more deeper into the business entities, right? So if you look at this, the sole proprietor, there's no liability protection for your business. What do I mean by that? Let's say you're in construction and you're building a house, right? And God forbid, you got the potential homeowner, right, comes to visit the site, and they step on a nail, right, or a plank with a nail in it, and their foot gets infected. They gotta go to the hospital, and all of a sudden some crazy stuff, they gotta chop off the leg, and they're like, you're at fault for me stepping on that nail, right? You should have kept your work area clean. And they sue you, and they sue the business, right? They're suing you. There's no protection, there's no buffer between your business and your personal life. So that person can sue all of you. They can take all your business assets, they can take your house, they can take your car. Like, they can sue all of you. There's no protection as a sole proprietor. And when it comes to taxes, it's done on your personal return, right? They have a schedule on your taxes where all of your business information goes. It's called the Schedule C. And it's very easy to manage. It's low complexity. So, it's one of the most popular businesses in the beginning. It's good for side hustles. Like if you're testing something like that, that's a good, way to start in business. But you always want to, start thinking about liability protection. And that's where, you got partnerships. Partnerships can be done as sole proprietor style, where just a bunch of people get together and go into business with each other. There's no liability protection there either. So if you get a partner to come in your sole proprietor, you become a partnership, all you're doing is spreading the liability out between multiple people, right? But there is still no buffer between the business and your personal lives. And then you have an LLC, which is the next level up. Now, an LLC starts providing you that protection because you're a separate entity. You get a tax ID number for that LLC. You have a whole different name for the LLC. So it starts providing that liability protection. It's also done on the Schedule C tax return because the IRS, for tax purposes, considers an LLC the same as a sole proprietor just for tax purposes, not for liability protection. But there is more involved in managing it. So it does, take a little bit more work to manage the LLC. But you are creating the protection, but there's stuff you have to do to maintain that protection. That protection is called the corporate veil, right? You have to maintain that corporate veil for your business. And there's things that we're gonna talk about, like separating your personal and business finances, right? And then you have a corporation. A corporation is its own, you're creating your own, another human. Let's just say that. You had a baby. And the corporation has its own name, has its own identity, has its own social security number, has its own, you name it. So it's its own person. It's growing up, it's grinning, it's becoming their own. Pretty soon you'll be separated from your child. Your child will go and live on their own and all that. That's a corporation, right? In the beginning, you're involved in the company, right? You're in there, but as the business grows, you're gonna have a board of directors, you're gonna have all of these people involved in that business that could eventually tell you, hey, time to step away, we're gonna take it from here, right? Your business is an adult now, we're gonna take it from here. You just become a shareholder in the business. Like that's the main, like that's the if you're looking to get investors, if you're looking to grow something large and huge, the corporation is that type of entity that you want to create. So there's a total separation when it comes to taxes as well, because a corporation being its own person is going to do its own taxes. So a corporation will pay their own taxes as well. So those are the types of business entities you have to consider when you want to start a business, right? There's a lot involved in there. We're going to go into the different ones. So we did it a little bit of it, so now I'll run through this a little quicker because I did this in that graphic. So it's the easiest and cheapest way to start. This is a sole proprietor. There's no formal entity filing needed. That means you can operate your business with your social security number. So that's how basic a sole proprietor is. It's you, right? Yeah, we can go to the next one. The partnership. So a partnership has 2 or more people involved in the business. Now you can be a partnership where you're all under your social security numbers, or you can be an LLC. So there's multiple partnerships there's multiple ways of having a partnership that you can think about. Having the LLC partnership, you're creating that liability protection. So it's adding that extra layer of protection on there. But it can arise without a formal filing. This is just a regular partnership, and you should always use an agreement when you're getting into business with people, because God knows there's going to be a bunch of he said, she said if you're in a partnership. So if you don't have how that partnership is going to operate on paper, black and white, that everyone can refer to, you're opening yourself up for problems. So be careful when you're getting into business with other people. Make sure you have agreements in place on what that partnership is going to look like and how it's going to operate. And it's good for co-founders. Like if you're just starting something out and you want to split the risk, partnerships are a good way to go. Now the LLC is where the protection starts coming in. It can shield your personal assets from business debt. That's honestly the way you want to go. You have to, if you're starting a business, you want to separate your business from your personal life. There's flexible federal tax treatment. What that means is an LLC can be on a Schedule C tax return, which is like a normal tax return, or you can ask to be taxed as an S corp, and it'll have its own tax return. And that means that you can just start putting yourself on payroll, and you can start taking some additional tax benefits out of operating your business. And that comes down the line. Like your business should be making a certain amount of net income before you consider an S corp, because there's costs associated with that. But there's more paperwork, right, than a sole proprietor, but less than a corporation, right? If you're an LLC, obviously because of that liability protection, you're gonna have more documentation involved in maintaining the business. But you're not a corporation, so there's less involved than a corporation. You just know the complexity is rising, right? But you wanna separate finances. That helps keep your business separated, helps keep that corporate veil in place. And it's great for many new small businesses. This is the next most popular business entity that's out there when businesses start. So LLCs are the next. And then corporation. This is the one. This is the big dog, right? You got the strong liability protection because a corporation is completely separate from you. It's like you start a business, believe it or not, you start a corporation, it's not your business. Right? You can be the majority stockholder, because in the beginning you're a stockholder when you create a corporation. You will start out as a majority stockholder, but as your business grows and you bring in more investors, that ownership goes down. You have pass-through taxation ability. What pass-through taxation means is like you can start as a C corp, and like the LLC, request to be taxed as an S corp, right? And that means that the net income of that business can flow to your personal tax return. That's what pass-through taxation means. The net income of the business flows to your personal tax return. There are some tax benefits on that. But if you're the C Corp, then the C Corp pays its own tax, right? So the C Corp is going to pay its own tax. You'll pay yourself out of the business, and then you will file your own tax return. You can take a dividend, and that's like, redeeming some stock or getting paid dividends as if you're investing in the stock market. It follows the same thing. That's a taxable event, so you would have to pay tax on those dividends. But there's a lot of things you got to do with a C Corp to keep it official. So you got to have bylaws, you got to have meeting minutes, you got to have corporate governance in place. Like the corporation is governed so much more, let's just say, critically than all the other business types. But it's great for outside investment, and it's just longer term planning is the C Corp status. There was one thing, yeah. So here's a question for you, right? If you got sued tomorrow, could someone come after your house or your car? Just think about you sitting right there that's watching this video. If you got sued tomorrow, could someone come after your house or your car the way your business is set up now? If the answer is yes, you might want to consider changing that, right? So, turn to your neighbor. Which of these entities that we discussed sounds like it's the right fit for you, right? That's a question that you want to think about. Even if you're in business right now, you can always change your entity. You can do it. So just talk to your CPA, talk to your accountant, talk to a lawyer. They can give you guidance around being able to put you in the right entity. Talk to the professionals. Now that you know what entity you want to be, right? Now you've got that all figured out. We detailed it perfectly for you. Now we got to figure out, all right, I got my entity. I can start selling my product. I can start making money, but I got to make sure I'm managing my expenses. I got to, I don't know really the process around that. How can I do that? So let's talk about it. Your entity, which we created right now, sets the rules. Now it's time to play by the rules, right? So the first step in making sure we're managing our business expenses properly is separating our personal life from our business life. Separating our personal expenses from our business expenses. So many businesses make the mistake of, living their personal life out of their business account. God forbid you have to report to the IRS all of your transactions, and they want to see proof. They want to see documentation. And because you've been living your personal life out of your business account, you don't have it. That's just going to open up the door for penalties and fines, and you having to, change deductions to income. So it increases your taxes. So you got to be very careful here. So a dedicated account makes records cleaner, and it helps preserve that liability protection. So if you have your dedicated bank account for your business or your dedicated credit card, right? Both. You should have a bank account and a credit card if possible for your business, dedicated just for your business expenses. That makes the records cleaner and helps preserve the liability protection. You want to preserve that liability protection. Now, how you pay yourself changes. Depending on your business entity, you can do an owner's draw. So it's an LLC and you take money out of your business, it's called an owner's draw. If you have a partnership and you pay yourself out of your business, it's called guaranteed payments. If you're an S Corp or a C Corp, put yourself on payroll. And if you're a C Corp or an S Corp as well, you take distributions out of your business when you need additional money, right? Aside from payroll, you can take distributions. So that's how paying yourself, depending on entity, matters. And then your tax treatment, it shapes the reporting. So, you can't report what's personal. So your setup affects how valid business expenses are reported and deducted. That's why we're talking about separating your personal and your business finances. The first step in getting a grasp on business expenses is first separating your personal expenses from your business. Open that business account, get yourself a business credit card, and whatever you need from your business, you use those accounts for those purchases. Here you go. Never mix personal and business money. right? I love how I lead into these slides, right? So mixing personal and business money is like putting gas and water in the same tank, right? They're both liquids, but nothing runs right afterward. You know what's funny about that? I want to say it was like 10 years ago. I went to a gas station. This was in New Jersey, and maybe it was longer than 10 years ago. I went to a gas station, and the gas station, the tank was damaged, I guess, from like a bad rainstorm or something that happened, and water got into the gas tank, right? So when I went to fill up my tank, it came out gas and water, right? So my tank, my fuel tank was contaminated, right? Literally, as soon as I leave the pump, my car shuts down. I didn't even get onto the road. Like, my car never made it out of that gas station. It shut down because gas and water don't mix, right? That's the same analogy, and I love that analogy because it hit home. It's true. Gas and water, they're both liquids, but water is not combustible, and it won't make your car run, right? If you mix gas and water, your car is not going to run. My car did not run after that, right? One way to separate your business and personal transactions is you open up that dedicated business bank account. You get you a business debit card. Well, the debit card should come with the bank account, but you got to get yourself a credit card, right? Pay yourself deliberately. That's a good one. Let's talk about that. Instead of just saying, oh, I need $40 today, or I need $100 today, right? Set up a schedule where you have to, this is where budgeting comes into place. If you know how much money you need on a weekly basis to live your life, right? Your personal life, let's say your personal expenses. You know how much money you need on a weekly basis, right? To be able to cover the month, right? Or you can do this on a monthly basis, whatever works for you. Then you just set up automatic transfers from your business to your personal account, or whatever that number is. It could be $200, $300, $400 a week, $500 a week, whatever you need to cover your expenses for the month, right? You do a weekly transfer from your business to your personal account consistently, as much as you can, right? To help cover your personal expenses, so you're not always digging into your business account, taking money out of your business account to cover personal needs. Because, you know, that gets into the world of when you're always in there, always dipping into the cookie jar, it gets into the world of what they call commingling, where you're just, you know, your business and personal transactions are back in the thing. You got to separate that stuff. So set up automatic transfers from your business to your personal, and do all your personal purchases out of your personal account. That's the best way. The IRS will look at that and be like, I see consistency here. It makes sense. It looks like that's what you're paying yourself, so you're good there. But if you're pulling money whenever you want to pull money, 20, 40, 100, whatever, it's commingling. You're basically commingling your money. And then, and especially as a sole proprietor, because you are yourself, so you got to be sure you can document your expenses and show the IRS, if they ever wanted to check, that you have documented expenses and you're doing it well. Track everything. Keep every receipt. Keep your receipts. If you're using a credit card, which is actually, some credit cards do great at this, they do the tracking for you. I know American Express and Chase, maybe US Bank, those credit cards actually label what the transaction is for. They'll add the label there for you, or they'll help, you can actually create the categories in those accounts, and so that they're tracking your expenses for you easier, right? Utilize those services. Your bank, some banks account, I know Chase does it, where, you know, if there's money coming out of your Chase checking account, it's labeled in categories for you, so that you can get reports, monthly reports, you can get annual reports, and it's broken down by category of expense, how you've spent your money that year. So if you're not ready for, you know, a QuickBooks account, which is accounting software or bookkeeping software that you can use to track stuff, if you're not ready for that, use your bank account. Set your bank account in a way that is tracking your expenses by category. Most business accounts can do that today. But you want to track everything. You want to make sure you're categorizing your rent and utilities, your supplies and inventory, software and subscriptions. You need that for your business today. Everybody's got subscriptions to help run their business. Are you marketing, right? Travel, your professional services, payroll, contractors, and insurance. All that stuff should be tracked and should be put in a category labeled by what you're paying, right? Create those categories. Like, you can do this on a spreadsheet. You don't need a bookkeeping software. You can use a spreadsheet if your bank account doesn't offer those categories, but create those categories and start plugging in the numbers as they come through so that you're tallying it up at the end of the month. A clear photo of a receipt is your support for record keeping. So if you ever have to pull up that information, you got it. So save your receipts. Let the tools do the heavy lifting. That, like what I was talking about before. You have accounting software, right? Such as QuickBooks. Wave is a good one. Xero is another one. We even use one in our office. It's called Patriot Accounting. Like, that's a really good, cheap accounting software that you can use for your business. Receipt scanning app. Like, most of these accounting softwares allow you to take a picture of the receipt and upload it to that particular expense, right? So that way you always have a receipt with that expense and your dedicated card statement. So this one is what I was talking about earlier. Your business credit cards can create those categories for you, and it gives you a good list of your expenses. So pick one. Start somewhere. Start with your credit card statement or your debit card statement. Pick one, and you don't have to wait for the perfect system, but pick one and start using it. Now, this is the IRS definition of business expense. A lot of people watch these social media gurus, and they're give you all of these expense ideas, how that you can expense travel, you can expense all this stuff, right? You gotta be very careful with what you hear on social media, because the IRS uses a rule, and it's called, is this expense ordinary and necessary for your business? So now, if you are, I'll give you a good example. Let's say you run an office, right? Like me, I run an accounting business, right? And in my business, because I run an accounting business, when I go places, I should dress, right, appropriately. So every time I buy myself an outfit, I'm expensing it against my business. Now, is that ordinary and necessary for my business, right? The question you have to ask yourself is, are the clothes that I'm buying able to be used personally as well? Like, can I go out to just eat with my family and wear the same clothes that I'm buying? If so, it's not ordinary and necessary for your business because you're using it personally. You have to make sure that what you're buying is tied to the business. So it should have your business logo on there. It should be a uniform if you're wearing uniforms, business uniforms. A good example is a construction company. You buy the work pants, you buy the work shirt, it's all business labeled, it's got all that stuff. That's a uniform. So that's ordinary and necessary for you because it protects you from the environment. You're not really going to wear that stuff out when you're going out with your family. Yeah, for the most part, some people do. I'm not judging, right? But typically you won't, right? So you have to ask yourself: is this ordinary and necessary for my business, right? If you're doing this stuff and the IRS wants to audit you and they see that these expenses don't fit that criteria, they're going to take that expense out, right? And that's going to increase your income at the end of the year, and you're going to end up being taxed on that money, and then you're going to get hit with penalties and interest too. So there's also some other expenses to be focused on that people don't necessarily take advantage of, but you should. If you're a home-based business, you can deduct your home office. That means if you've got a room in your house that you work out of, right? That's called your home office. You get a deduction for working in that room. You don't get a deduction if you work on your kitchen table, right? You have to have a dedicated space in your house that's just for business, right? Then you get the home office deduction. So you have to be very careful about when you're taking that home office deduction. Are you detailing an actual space in your house used solely for business, right? If so, you're able to take that deduction. Your vehicle, track that mileage. Only business mileage. You can deduct business mileage. That's a great deduction for business owners. The home office deduction, the vehicle deduction, and meals. Believe it or not, if you're taking out your clients to eat, you get 50% deduction on that. You can deduct 50% of that meal. You don't get the deduction for yourself, you get it for your client, right? You get that deduction for your client. When it is not obvious, let's say there's a deduction or there's an expense coming up that you really don't know if you can take it or not. Let's say you want to go to a convention. You want to go to a convention one weekend, but you want to take your family. And you're not sure if you can deduct that travel to that convention. Let's say it's in another state. So if you have questions like that, ask somebody. Reach out to me. I'll be more than happy to give you some guidance on that. Because believe it or not, there are ways for you to deduct that trip, especially if you're going to a convention, which is business related, right? Take advantage of that stuff. All right, now we're gonna wrap up the rules. Build a habit so you're skipping the mistakes. Review your expenses on a monthly basis, not just at the end of the year, right? Because then you're gonna get surprised if you owe money and you're gonna be yelling and screaming at your tax preparer like it's their fault when you should have been tracking your expenses throughout the year. Take accountability for yourself, okay? It's your business, not theirs. So if anybody should be tracking their expenses, it's you. Watch, unless you hire them on a monthly basis, then you work together, right? But watch your fixed and variable costs. Those are two types of costs in the business that you should be watching. Fixed costs are more like rent, utilities, costs that are consistent on a monthly basis. Those are fixed costs. Variable costs are costs that go into completing a job. Let's say you had to hire some people to be able to do this job. So you have to hire people just for that job, or you have to buy material just for that job, or you have to buy something just to complete a job. Those costs vary, so you want to make sure you're really paying attention to those costs too, so that you're not spending more than you have to. And then know your cash flow before you spend. Like, don't just buy something because you need it. Make sure that you can afford it. Right? Put a proper plan in place before you make these major purchases. So here's some new owner mistakes that are very common. You don't have a separate bank account for your business. You don't keep records until tax time. And you're guessing instead of tracking. And you're calling personal purchases business. Don't do that. Now, here's a little quick quiz. Let's see if you're ready. See if you've been paying attention. True or false? A sole proprietorship is legally separate from its owner. True or false? False. Next one. Which entity can provide liability protection and default pass-through taxation? Oh, yeah, that's a tough one, huh? Yeah. Default pass-through taxation, right? LLC. So an LLC can provide you limited liability protection, right? And also what they mean by pass-through taxation is the net income of the business flows to your personal tax return. So that's the LLC. It gives you the default pass-through taxation. Number 3, true or false? 2 friends can create a general partnership without filing formation documents. True. Yes, you can. Because remember when we spoke about it, you can be just 2 buddies that decide to, get into business together, and you're planning like founders or whatever, and you just spread the liability between the 2 of you. 4, fill in the blank. A deductible business expense must be
ordinary and necessary.
Ordinary and necessary. If you use that thought process when you're doing a purchase or something like that alone, just that process alone will protect you. Trust me. 5, true or false? Mental notes are enough when personal and business money share one account. So if you keep, I know, I got it right here. I got the receipt in my brain. I'm tracking it. You think that's enough? False. 6, which is not typically a business expense? Software, office supplies, personal groceries, or a client lunch. Which of those is not a business expense?
Personal groceries.
Yeah.
How many people go to the store anyway and put it on their business account? A lot. You're wrong. 7, true or false? A legible backup receipt image can support record keeping.
Sure.
True. Always keep documentation. When it comes to keeping your business in good standing, it's documentation, documentation, documentation. Write yourself a note on a piece of paper, write down something, take a picture of it, and keep it, right? Documentation. 8, what is the strongest reason to separate business and personal money? A, clear records. B, liability discipline. C, professional banking. Or A, all 3. Or I said A. D, all 3. All 3. Yep, perfect. Good job, guys. You've been paying attention. Here's the answers. And I think we got them all. We did pretty good. Now, your turn. What expense categories worry you the most? Write that down and shoot me a message, and we can discuss it. We'll set a time to go over it. Which entity sounds like your fit? Right? From the explanation of entities, which one do you think fits you the best? Have a conversation with a professional after that, right? And just so you can go over your idea of business and all that stuff. And what is one thing you will change this week? From this workshop, what's one thing you'll change this week? Hopefully it's keeping track of your expenses. 3 things to remember. Number 1, pick the entity that matches your risk and goals. And you can also revisit that as you grow. Believe it or not, you can adjust your business entity. You can make changes to it. Number 2, separate your money from day 1. You gotta separate your money from day 1. It's hard to go back. And if you hire a bookkeeper and they have to go back and start separating stuff for you, it's gonna cost you money. If you start doing it from day 1, using a spreadsheet, using whatever tool to your disposal, you'll be in a good position. Track every business expense and preserve the supporting documents. Documentation, documentation, documentation. I can't stress that any more than that. Turn today's lessons into actions. Here's your next 3 steps. Here's what you're going to do after this workshop. You're going to talk with a CPA or attorney about your entity, or you can call me. Open a dedicated business bank account this week. If you don't have one, you're going to open one. And you're going to choose one expense tracking tool and start using it. I tell everybody, start with Excel. When you're just starting your business, you don't have money to hire a professional, start with Excel. It's a great way. Actually, Excel has expense management templates already out there. You just got to do an online search, download one, and just start plugging those numbers in there so that you're keeping track of your expenses. Believe it or not, if you start with Excel and you do it consistently, you do it right, when it's time to get a bookkeeper or somebody to help to take that over for you, they can take that information and upload it to a system and run with it. Very easy. So use something free. Excel is free, right? Use it free to get you the exposure, to get you into the habit of tracking your expenses, but you got to start with something to build that habit. All right? And I think that's it. That's it. Done. Thank you. See you in the next workshop.